From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, the final reading of U.S. consumer sentiment confirms one of the lowest numbers on record, with long-term inflation expectations climbing to the highest in more than 30 years. As the U.S. and China deliver mixed messages on the status of trade negotiations. And all the uncertainty leading Fed officials to say rate cuts may be coming as soon as June. We begin with the big issue, policy uncertainty whipsawing the bond market.
This is a completely different world.
If these policies and these tariffs stay in place, then we will have a recession with a very high probability.
Higher tariffs are bad for prices.
Inflation risks are to the upside.
The stagflationary shock and rising inflation undermines the ability of bonds to perform well.
Bonds are volatile in a way that cash is not.
We're a little bit concerned about the increase in volatility.
The bond market's telling us, watch out.
We had yields move much lower, then move much higher. We're right back where we started.
I do think that there's a bit more pain. I've talked about a 5% 10-year.
US rates are priced to be above 3%, above their neutral rate over the next few years. And that's, I think, where there's tremendous opportunity.
We have right now an economy that is still robust if you look at the hard data.
The Fed is in a very tough place here.
If we do have very weak reports, yes, I think they'll definitely be in a position to cut rates.
The Fed is going to cut this year. I mean, it's funny that this is like controversial.
And I do expect that by the end of the year, we'll be seeing rate cuts, but it could take us a few months, and it may not be at the first sight of weakness.
And let's take a look at just how uncertain the outlook is for economic policy. Coming down from the peak, obviously, earlier this month after trade negotiation onslaughts came ahead and after we saw a little bit of rolling back of some of the tough rhetoric. But we're still very elevated. This index based, of course, on a number of things. Newspaper mentions the word uncertainty or certainty or certain, and also legislation and what newspapers are reporting on in terms of what's coming down the pike in Congress. So let's flip up the board and see how this has been impacting assets, or vice versa, if you like. We can see that the dollar weakness has unwound just a tiny bit. We still have a weaker dollar. I don't know if we have a weak dollar. We'll ask our guests. And then the 30-year yield, just expressing some of what's going on in the bond market, down to 4.72 right now from its high levels. This obviously some of the sell America trade, which is reversing just ever so slightly this week. So speaking of U.S. Treasuries, yields falling across the curve after comments from Fed officials added to rate cut bets. Let's take a listen to Fed Governor Chris Waller speaking right here on Bloomberg TV earlier this week.
Wouldn't surprise me that you might start seeing more layoffs, tick up in the unemployment rate going forward if the big tariffs in particular come back on. No, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Joining us now, Priya Misra, Portfolio Manager at JPMorgan Investment Management. And Priya, I want to start with your firm's role and note out this week on recession odds. Economists writing that, quote, with the damage to sentiment already in place and an average effective tariff rate around 15%, we would still keep our estimated odds of a US/global recession around 60%. That's Joseph Lupton and the team there as well. If that's the case, and that's pretty much the worst case scenario, this is if China tariffs don't come off significantly, is the assumption that the Fed will cut and that the Fed will still be able to be the lender of last resort to the world and we might get saved? Is that why we're seeing bond yields at these levels? Because it doesn't seem that bond yields are pricing in 60% odds of a recession.
I agree. And I think actually no market is pricing in as high as 60%, even 50% odds of recession. You see the market actually a little bit more calm. So I'll address your question of the Fed in a second. But I think what we've got in the last week, the reason for this calm, I would argue potentially complacency, is the idea that the U.S. administration or the president might be open to negotiations. You know, because what was the end game of this? Was it zero trade deficit? Was it getting fair trades and deals? Was it ring fencing China? I think we've been grappling with was it raising revenue? In which case those tariffs have to stay in place. I think what we're hearing is we got the pause. I think the bond market has spoken. We saw that on Monday as well. The bond market reacted, and then we heard from the president that firing Chair Powell was actually not something they were talking about. So I think there is this hope that the end point, and I'm going to address, I think what's important is that end point. Where are we in terms of effective tariff? If the rest of the world is at 10% and China is at 60%, I think that's a high effective tariff rate, 12, 14%, much higher than the 2% we came in with. But at least knowing that is that the end game. And then how long does it take? I think what the market and the Fed is grappling with is there's a high amount of uncertainty. You talked about uncertainty. So when we talk about the Fed reaction function, and all we got this week was really, I think, Fed officials explaining that if the hard data weakens, and it hasn't yet weakened, but if it does, they would, some say that they'll respond right away. Others are arguing, I think Chair Powell would say, we need to make sure inflation expectations are well anchored. Now, our view on the Fed is they can't be preemptive. Inflation is above target. They still haven't seen the hard data weaken. We came into this year in a position of strength from the economy standpoint. And so I think they can't be preemptive. Once the economic data, and notice I'm saying once and not, or when it happens, not if it happens. I think it's just a matter of time. The economic data is going to weaken. We think if the wage number stays anchored, that's going to be key to keeping those inflation expectations anchored. If you see the unemployment rate starting to rise, layoffs starting to pick up, and wages stay contained, inflation expectations from the market, not just Michigan, not just surveys, that stays contained, we think the Fed will start to cut. And I think once they start, I'm almost arguing for them starting a little late. Once they start, this Fed is not shy. They're going to cut aggressively. I think the market's underpricing how much they'll cut in totality, even though they might start a little late.
Well, so for futures pricing in almost 100 basis points of cuts by January, so that's one measure, but there are other measures out there that are not quite pricing in that many cuts potentially. George Bory, I want to bring you in. George Bory is Chief Investment Strategist for Fixed Income at Allspring Global Investments. George, before all of this kerfuffle, before we had any idea what the tariff policy was going to be, not that we know anymore now, but before we got the onslaught from President Trump, we were looking at spreads for IG of around, 80 basis points, 300 for high yield. We're now at something like a 368 basis point risk premium on high yield. Priya mentioned the word complacency. Do you see complacency in the last few days in this market?
I think we think it's been a meaningful repricing, and it's more of an uncertainty premium than kind of an economic hard landing. And I think that's really important to emphasize. It's also sort of the constituents in the construction of sort of corporate America, if you will, and sort of where they sit today relative to the potential shocks that are kind of coming down the road. And so while credit spreads were very, very tight at the beginning of the year, we saw a meaningful kind of repricing to kind of calibrate really with the uncertainty, with the uncertainty introduced from tariffs, and similar to what Priya was saying about kind of the Fed waiting to see hard data. I think the credit markets are doing the same. There continues to be more of a rotation within the credit markets than just sort of an aggregate sort of net risk reduction. So credit spreads today, in our opinion, they signal a slowdown in growth, but clearly not a hard landing, and certainly not a super hard landing in the form of a recession. So if we do head towards that recession, and we do think that the chances of it happening, and similar to what Priya said, are pretty high, and that we're going to see some meaningful headwinds unfold. You could see credit spreads go meaningfully higher from where we are right now. So we do have a cautious stance within credit. It's more the sector rotation within the credit markets. And what we do emphasize that many companies, both on the investment grade and the high yield side, they come into this in pretty good shape. They're able to reprice their earnings, so they have some level of an inflation hedge. Input costs as they come from overseas, obviously a big consideration, so some margin compression you could see there. But most importantly are just balance sheets. And companies that have good, well-funded balance sheets are going to continue to weather the storm. And we think that perhaps is the most important thing any credit investor can focus on today. If you have that financial flexibility, then you can withstand a lot of volatility.
But balance sheets can change awfully fast. Cash flows can change awfully fast. We know this, Priya. So I'm curious, if we get one bilateral trade deal, say it's Japan, say it's India, which both look more likely than some others now, does that help? Do we have any more certainty then? Is it a different outlook on growth if we have one of those trade deals and potentially a blueprint for others? Or is that really just more confusion?
Well, I think if you get one or two, at least you get that blueprint. You get the idea that the US is willing to come to the table, and then we kind of see what is that, if we get a trade deal, and again, we're not going to get a full trade deal, we're going to get a blueprint agreement in principle. Is that a 10% rate, or could it be lower than 10%? Because we're all trying to figure out that end game. Where is the effective tariff rate at the end? So no, it doesn't help a lot in terms of, it doesn't solve all the problems, but it gives you a bit of a roadmap. And then we realize, okay, this might be where the end point is. And I think the faster it gets done, the more conversation, that uncertainty that we're all talking about. We heard it all week at the IMF. We heard it, among companies. The longer people don't do anything, whether it's companies or consumers, the more the odds of growth slowing down increase. And then this uncertainty premium or risk premium starts to rise across assets. So I would agree with George. I think going up in quality, but owning some credit and owning duration. I still think duration is that hedge in that 5-year sector.
We have to leave it there already. Thank you to both of you. That is Priya Misra of JPMorgan Asset Management and George Bory of Allspring. Up next, the auction block. Issuance picks up and recovers from the slowdown caused by the market volatility somewhat. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield, and it's time now for the auction block. After a slowdown in deals earlier this month, we saw issuance pick up again this week. We start with Treasuries, where we had sales for the 2s, 5s and 7 years. We saw the lowest awarded yields since September for all these auctions. Looking at credit, US high-grade sales were highlighted by deals from American Express, Walmart and Bank of America. That brought the weekly volume to just shy of $25 billion, near the upper end of forecasts. Walmart saw demand skyrocket, over $21 billion. And in high yield, banks upsized a deal supporting QXO's acquisition of Beacon Roofing by $500 million after strong investor demand. It marks one of the first deals backing a large acquisition since all of the tariff-induced volatility. And speaking of credit, Newton Investments' Ella Hoja remains positive on the space.
You can still play for some widening in credit spreads, but there are attractive yields available now. Certainly in the high yield universe, you're getting, wherever you can get 9% plus yields, you can lock those gains and expect decent returns going forward. Of course, you have to pick carefully.
Despite this optimism, on the Bloomberg Intelligence Credit Edge podcast, BlackRock says risky corporate debt markets have room to drop further, saying, quote, if this uncertainty continues for another quarter, 2 quarters, 3 quarters, that could lead to a more significant downturn. Joining us now, John McClain, Portfolio Manager for High Yield and Corporate Credit Strategies at Brandywine Global, and Colleen Cunniffe, Global Head of Credit Research at Vanguard. Thanks to you both. And Colleen, let me start with you. How have you made it through this whole period, and are we done yet? Can we take a breath, a sigh of relief?
Well, first of all, thanks for having me. And look, how have we made it through this whole period? By focusing in on what we do best on my team. We're, as I've said before on this program, we're deep fundamental credit research analysts. And so, if you anchor to that, if you really understand your companies and your cash flows, you can kind of navigate through these very tumultuous times. Are we through the worst? We're hopeful that maybe we're through the worst. Not to say that volatility is not going to continue as we continue to try to understand how the tariff picture will roll out, but we are cautiously optimistic that maybe we're through the worst of it.
John, FTI says it's seeing a pickup in tariff-related restructurings by companies, and I'm curious, are you waiting to see lots more of these? Is it providing any opportunities? Are you starting to look at balance sheets that you wouldn't have been looking at, let's say, a month or two ago?
Well, we absolutely see a micro dislocation in the market with companies that are meaningfully exposed to potential tariffs or tariffs as they stand today. So absolutely, we're refocusing our efforts and sharpening pencils on a lot of sectors. Things like autos and energy have certainly widened out pretty materially. And similar to how inflation is a regressive tax on the low income, tariffs are a regressive tax on smaller companies. So I think it's early innings in terms of restructuring and, balance sheet LMEs for some of these smaller companies, but we're certainly paying attention.
Yeah, you talk about Autos, Alex Partners was saying that many consulting firms have set up literally tariff war rooms for automakers. But with high yield and even triple C's pricing, not that crazy high. I think high yield is under 8% right now and triple C's maybe a little bit more than that. Is that enough of a reward for taking this kind of risk?
No, it's not. We have not stepped in materially to autos at all yet. We're waiting for the OEMs to join the party in high yield over, the coming year or so here. So I think there's a lot more pain to be felt. But yeah, I think right now it's do your homework and be ready to act. As soon as we see liquidity come out of the marketplace, we will see prices change dramatically. That's what we saw at the beginning of April. We saw liquidity coming out of the market. We saw pricing change materially, and we were ready to act. So we're back to this complacency part of the market. We're back to the market saying things like, we're not going into a recession. We have a plan. We don't think that's the case.
What about you guys, Colleen? Because I know that you were looking at perhaps the odds of a recession and how the market's only pricing in maybe 30, now maybe 40% odds of recession. Could go higher. Where are you looking to be rewarded for taking that kind of risk? Is it out of the US and maybe into Europe now?
So just as you guys know, over the last couple of weeks, we've experienced a couple bouts of volatility across the corporate markets in general. And so there have been opportunities to sort of step in, and we have a shopping list of names that we like and feel comfortable with. So we have seen a couple of those opportunities. Things have tightened back in again, so slightly less attractive. We do view Europe as probably, again, relative to itself, maybe still a bit rich, but relative to the U.S. as an attractive opportunity. You have some puts and takes there, again, impacted by tariffs certainly, but also fiscal stimulus coming out that may counter that a bit. So that is one of the areas that we're looking at.
And so does it matter to you then if there are deals? So for example, if we get a big deal with, one of the countries like Japan or India, not Europe yet, but if we get those, will your focus turn to those countries, or will you be waiting for something to happen regarding Europe?
We will be looking at deals getting done as a signal more broadly, right? I think as one of your previous guests I was listening and was talking about, it's an important signal, but these things are all connected. We would need to see continued progress to make sure that the uncertainty that we're experiencing around these markets becomes clear and allows us to, again, focus in on the fundamentals that we understand, be able to appropriately create, what I call bookends of scenarios, right? What are our bookends? And make sure that we're getting paid for whatever risks we're taking.
John, you were talking about balance sheets and liquidity and so on. And, balance sheets had been pretty strong coming into this. But again, if liquidity dries up and if companies are, slave to floating notes, right, then they might have problems. What do you do and what have you been hearing from companies that are exposed to those kinds of loans?
Yeah, you're right. Credit's levered to the balance sheet. I think that's a much easier conversation to have today, particularly on the fixed rate side of things. Look, leverage is reasonable, coverage is strong, quality of the asset class is good, and starting yields and dollar price are pretty good. But to your point, in terms of floating rate, we think you could be hit with the proverbial double whammy. As soon as the Fed starts cutting, you're supposed to sell risk there. Your base rate's going to head lower, your credit spread's going to widen. When you look at the broadly syndicated loan market and private credit, you're dealing with lower quality businesses, and particularly in private credit, as I mentioned before, smaller companies that I don't think have the access to the plethora of different markets in terms of funding. So, I think you're supposed to be getting in front of this at this point right now, and I think floating rate is probably the worst place to be within fixed income.
So do you anticipate defaults, or do you anticipate huge restructurings, or just severe pain?
Defaults will tick up to a degree, but it's going to be a lot more on the proactive liability management exercise. These things are coming quicker, sooner, and so you actually don't get into the default scenario. And actually, the other piece of it, too, is the access to different forms of capital that companies have at this point in time. So, private credit really wasn't around during the GFC. And then you have the asset-backed market really growing as outlets for high-yield, below investment-grade borrowers to tap. So I think we're still in that point in time where different forms of capital will provide loans. to a number of these companies. So that's going to mitigate your defaults, but we're certainly going to see a lot more restructuring.
What would you say to those people that had really got into leverage loans in a big way when they looked attractive and suddenly there were record outflows? And what have you done? Did you ride it out? Would you be, escaping now while you can?
I think you use this time to pull back. Absolutely. I think that floating rate has done and performed extremely well since we got into the Fed hiking cycle. But as we go into the cutting side of things, you're supposed to be leaving and finding greener pastures. All
right. Well, always best to be the first out. Thanks to both of you. That is John McClain of Brandywine Global and Colleen Cunniffe of Vanguard. Still ahead, the final spread, the week ahead. Mag 7 earnings, the April jobs report, and President Trump's 100th day in office. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up, Monday, Canada's election gets underway. Plus, we have remarks from Ollie Rehn of the ECB. Tuesday, GM earnings. US consumer confidence, we'll get another reading on that. And the JOLTS job openings data, which should show us a little bit more about the labour market. Plus a slew of earnings from Visa, Coca-Cola, Starbucks and more. What will they say about the consumer? What will they say about their tariff-related costs? Wednesday, Mag 7 earnings kick off with Meta and Microsoft. Plus we get US GDP readings and that all-important core PCE data. Thursday, two big ones, Apple and Amazon report. We also have a BOJ rate decision and earnings as well from McDonald's, CVS, MasterCard and Eli Lilly. Friday, if you make it that far, we'll get the April jobs report. That will be a big one. Earnings from Chevron and ExxonMobil and the Berkshire Hathaway annual meeting comes on Saturday. Maybe we'll get a few words of wisdom from the Oracle of Omaha. And for my final thought, let's look ahead to those jobs data. The median estimate in our survey calling for an increase of 130,000 jobs, down nearly 100,000 from March's figures. The unemployment rate projected to stay steady at 4.2%. Traders, economists and of course Fed officials will be keeping a close eye on the labour market data, as any prolonged weakness could spark the need for rate cuts later this year. When those rate cuts will come, well, it's not looking like May. Nobody seems to think it will be May, but it could, of course, suddenly be June, and June is just around the corner. This has been Real Yield on Bloomberg TV.